In this video we will discuss about capital expenditure.
What are capital expenditure?
A capital expenditure, CapEx, for short, is the payment with either cash or credit to purchase long-term physical or fixed assets used in a business's operations. The expenditures are capitalized, that is, not expensed directly on a company's income statement, on the balance sheet, and are considered an investment by a company in expanding its business. CapEx is important for companies to grow and maintain their business by investing in new property, plant, equipment, PP&E, products, and technology. Financial analysts and investors pay close attention to a company's capital expenditures, as they do not initially appear on the income statement, but can have a significant impact on cash flow. Capital expenditures normally have a substantial effect on the short-term and long-term financial standing of an organization. Therefore, making wise CapEx decisions is of critical importance to the financial health of a company. Many companies usually try to maintain the levels of their historical capital expenditures to show investors that they are continuing to invest in the growth of the business.
When to capitalize and when to expense?
The decision of whether to expense or capitalize an expenditure is based on how long the benefit of that spending is expected to last. If the benefit is less than 1 year, it must be expensed directly on the income statement. If the benefit is greater than 1 year, it must be capitalized as an asset on the balance sheet. For example, the purchase of office supplies like printer ink and paper would not fall under investing activities on the cash flow statement, but would instead be an operating expense on the income statement. On the other hand, the purchase of a building, by contrast, would provide a benefit of more than 1 year and would thus be deemed a capital expenditure. Types of capital expenditures. There are normally two forms of capital expenditures. 1. Maintenance CapEx. Expenditures to maintain current levels of a company's operations. 2. Growth CapEx. Expenditures that will enable an increase in future growth. It is important to note that funds spent on repair or in conducting normal maintenance on assets are not considered capital expenditures and should be expensed on the income statement. Let's summarize our today's topic. 1. A capital expenditure, or CapEx, is the purchase of long-term physical or fixed assets used in a business's operations. 2. Financial analysts and investors pay close attention to a company's capital expenditures, as they do not initially appear on the income statement but can have a significant impact on cash flow. 3. The calculation of free cash flow deducts capital expenditures. Free cash flow is one of the most important calculations in finance and serves as the basis for valuing a company.